Hello, traders. Steve Gans here, and I'm going to try something with this episode. I've had a number of people ask me about doing a podcast. So I'm actually going to do this by creating it as a conversational podcast. There's not going to be visuals other than it's going to have a transcription showing up. But aside from that, it's basically something you can listen to while you walk, etc. And it's going to be around options in general. What are options? How do they work? So it's going to be kind of a basic tutorial, but even if you've traded options for some time, I think you'll find some value in it. So take a listen, and as always, please give me any thoughts or comments. And of course, if you like this, please like, subscribe as well. Thanks so much, everyone, and I hope you enjoy the podcast.
All right, so today we're diving deep into options trading. You guys send in a ton of videos and stuff. I mean, it's like a whole curriculum here, from the basics all the way up to like seriously advanced strategies.
Yeah, it's quite a lot.
But our goal, let's break down these key concepts and make options trading understandable. That making your head spin.
Exactly. So we're going to start right at the beginning, the foundations, what an option actually is. Then we'll look at those fundamental building blocks, calls and puts, and how those work.
And then we'll get into how those are used in different strategies. Some of them simple, and then, some of them get a bit more let's say, intricate.
Oh, absolutely. And of course, we have to dig into the things that make options tick, right? The Greeks, volatility. There's a lot to unpack, but by the end of this deep dive, you should have a solid grasp of how options work and the power they can offer.
Okay, so let's answer that first big question. What is an option? One of the videos used this analogy, and I thought it was spot on. An option is like a contract, right? But it's a contract that gives you the right to buy or sell something, but not the obligation to do so. And that something is usually an underlying asset, like a stock.
It is. It's like putting down a deposit on, say, a house. You have the right to buy it at a certain price. That's the strike price. For a certain period, that's until the expiration date. But if you change your mind, you don't have to go through with it. You just lose your deposit. That's similar to an option, where the most an option buyer can lose is the premium they paid.
Right. That premium is basically the price you pay for that, right? But not the obligation.
Exactly.
Okay. And within the world of options, we have two main types, call options and put options. Let's start with calls. What's the idea there?
A call option, it basically gives you, the buyer, the right to buy the underlying asset at the strike price. So when you buy a call, you're hoping the price of that asset is going to go up, ideally by a lot, and that's going to happen before the option expires. You're betting bullish.
One of the videos had a great example.
Yeah.
Someone buying an Apple call option with a strike price of $190, expiring in September. They paid a premium of $6.80 for this. They're betting that Apple stock price is going to climb above $190 and high enough to make a profit after covering that premium. But remember, they have to be right within that time frame.
Absolutely. Options have that limited lifespan, unlike owning the stock directly. Your prediction has to come true before the expiration date.
Got it. So with calls, you're hoping the price goes up. Now, what about puts?
A put option gives the buyer the right to sell the underlying asset at the strike price.
So basically, if you think the price is going to go down, you buy a put.
You got it. Puts are a bearish bet. You think the asset's price is going to drop below the strike price before the option expires. And this can be a way to make money when the market's going down, or even protect yourself if you already own the stock, like an insurance policy against price drops.
Okay, so that covers the basics, right?
Mm-hmm.
Options are contracts. Calls are for when you think the price is going up. Puts are for when you think it's going down. But here's the other side of the coin. For every buyer of an option, there has to be a seller.
Right. And that seller, they're the one who has the obligation to fulfill the contract if the buyer decides to exercise their right. So let's say you sold that Apple $190 call we talked about. If the buyer decides to exercise their option, you, the seller, you're obligated to sell them those Apple shares at $190, even if the market price is much higher.
So that's where the risk for the seller comes in.
Exactly. You're taking on the obligation in exchange for that upfront premium.
Okay, we've got the foundations. Options is contracts, calls versus puts, the buyer's right versus the seller's obligation. The next layer of this whole thing is option strategies. The material started with single leg strategies. What exactly are we talking about here?
These are strategies that use just one type of option contract at a time. The simplest one, that would be a long call.
Right, so that's simply buying a call option. The exciting thing about this strategy is that your potential profit is unlimited, at least in theory. There's no cap on how high a stock price can climb.
True, but on the flip side, your potential loss is limited to the premium you paid for the call.
Yeah, like in that Apple example, the most that buyer could lose is that 6.80 per share premium they paid.
Right, which is why some people see buying a long call as an alternative to buying the stock itself. It offers potentially higher returns, but you have that limited time window to be right.
Okay, then there's the short put. Now, this is where it gets a little tricky because this is also considered a bullish strategy. But wait, aren't puts all about betting the price will go down? How can a short put be bullish?
Well, a short put means you're selling a put option. And when you sell a put, you're actually hoping that the underlying asset stays above the strike price until the option expires worthless. If that happens, you keep the premium you received for selling it.
So, in our Apple example, if someone sold a $190 put, they'd be rooting for Apple's price to stay above that 190 mark. If it does, they just pocket the premium. Easy money, right?
That's the ideal scenario. That premium represents the maximum profit on the trade.
But there's got to be a catch, right? What's the downside?
Here's the risk. If the price of the underlying asset drops below that strike price, the buyer of the put can exercise their option.
And what does that mean for the seller, the one who sold the put?
You'd be obligated to buy that asset at the strike price, even if it's trading lower in the market. That's where the potential losses can really pile up, though theoretically they're limited, since the stock can't go below zero.
So you get that nice upfront premium, but you're essentially agreeing to potentially buy a stock at a price you might not like. It's a trade-off.
Right, it's all about weighing risk and reward.
Okay, so we've got long calls and short puts. And then there's this whole other category, the multi-leg strategies, where you start combining multiple options contracts. The material mentions some of them, like vertical spreads, iron condors, even iron butterflies. Why would anyone want to get into these more complex strategies?
It's all about trying to fine-tune your risk and reward, basically crafting a trade with a more specific goal or outcome in mind. You're combining buying and selling different options on the same underlying asset, but with different strike prices or expiration dates.
So it's like you're building a custom option position.
Yeah, it's like that. Instead of just buying a call, you might also sell a call, but at a higher strike price. That's called a bull call spread, and it caps your potential profits, but it also makes the trade cheaper to enter.
Got it. So it's all about achieving a specific outcome with calculated risks and rewards.
Exactly. You're using multiple legs to manage your risk and express a particular view on where you think the market's going.
Okay, the next big concept that kept popping up is intrinsic and extrinsic value. These seem fundamental to understanding how options are even priced in the first place. Let's break it down. What's intrinsic value?
Think of intrinsic value as what an option is worth right this second. It's in the money value. And only options that are in the money have intrinsic value.
Okay, so what does in the money actually mean?
For a call option, it means the current market price of the underlying asset is higher than the strike price.
Okay, so if Apple is trading at, say, $195 and you have a call option with a strike price of $190, that option is in the money.
Exactly, because you could immediately buy Apple at $190 and sell it at $195, making a $5 profit, at least before accounting for the premium you paid for the option. That $5 difference, that's the intrinsic value.
And what about put options? How does in the money apply there?
With a put option, it's in the money if the strike price is higher than the current market price. So if Apple is trading at $185 and your put option has a strike price of $190, that put is in the money.
Because you could buy Apple at $185 in the market, then exercise your put option to sell it at $190, again making a $5 profit before factoring in the premium.
Precisely. And if an option isn't in the money, its intrinsic value is zero.
Got it. So intrinsic value is all about what the option is worth right now. What about extrinsic value? That was sometimes referred to as time value. What's that all about?
Extrinsic value, think of it as the extra value an option has on top of its intrinsic value. It's the potential for the option to become even more profitable between now and its expiration date.
So even an option that isn't currently in the money can still have extrinsic value.
Absolutely, because there's still time for the underlying price to move in a favorable direction.
So going back to our Apple example, let's say that $190 Apple call, with Apple trading at $195, which we know has $5 of intrinsic value, is actually trading at $7. That extra $2, that's the extrinsic value.
Exactly. That $2 reflects the market's expectation that Apple's price might continue to rise before September, or that it might experience large swings in either direction, creating more opportunity for profit.
So time and the potential for price volatility, those contribute to extrinsic value.
Absolutely. But here's the crucial thing to understand. Extrinsic value gradually erodes as the option gets closer and closer to its expiration date. It's called theta decay, and we'll dig into that a bit more later.
Okay, so intrinsic is the right now value. Extrinsic is the potential value that's affected by time. Now, the material also talked about the Greeks. Can you give us a rundown of what those are all about?
The Greeks, think of them as tools to measure how sensitive an option's price is to changes in different factors. The main ones you'll come across are delta, theta, and vega.
Yeah, delta was described as measuring how much an option's price is expected to change for every dollar change in the underlying asset's price.
Right. The delta of a call option is usually between 0 and 1, while for puts, it's between -1 and 0. A long call has a positive delta, meaning its price moves in the same direction as the underlying stock price. Let's say you have a call option with a delta of 0.5. If the stock price jumps up by $1, you can expect that option's price to rise by about 50 cents.
And I remember one video talked about delta hedging, where you could sell call options against, let's say, your existing shares of stock to reduce the overall delta of your portfolio.
Right, so you're trying to balance things out so that small price movements in the stock don't have a huge impact on your overall portfolio value. It's a way of managing risk.
Are there any downsides to this constant rebalancing, though? Like, doesn't that lead to a lot of trading?
Yeah, that's a good point. Delta hedging can involve quite a bit of trading, which means transaction costs. And sometimes it can even eat into your profits if the stock makes a big move in your favor, because you're basically hedging away some of that potential upside.
It's a balancing act, for sure. All right, next up, theta. What does theta measure?
Theta, it's all about time decay. Remember how we said that extrinsic value gradually fades away as the option gets closer to expiration?
Yeah, it's like a countdown clock.
Exactly. Theta measures the rate of that decay. It tells you how much value an option is expected to lose each day, all other things being equal.
So theta is working against you if you're buying options.
Well, generally, yes. Theta is negative for long options, whether calls or puts, because as time ticks by, that extrinsic value erodes. For option sellers, though, theta decay works in their favor.
Right, they want that option to become worthless by expiration, so they get to keep the premium.
Exactly. And there's a key thing about theta, that time decay accelerates as you get closer to the expiration date. It's like a snowball rolling down a hill. It picks up speed as it goes.
So if you're buying options, you're kind of in a race against time.
You need that underlying asset to move in your favor and fast to offset the effects of theta decay.
Okay, so we've got delta and theta. The last Greek on our list is vega. Fill us in on that one.
Vega, this one measures how sensitive an option's price is to changes in implied volatility.
Implied volatility, that's kind of like the market's expectation of how much the price of the underlying asset is going to fluctuate in the future, right?
You got it. It's a measure of uncertainty or expected price swings. Vega tells you how much an option's price is expected to change for every 1 percentage point change in implied volatility.
And why is vega positive for both long calls and long puts?
Think of it this way. Higher implied volatility means there's a greater chance of big price swings in the underlying asset. And that uncertainty makes both call and put options more valuable because it increases the likelihood that they could become profitable.
So it's like if the weather forecast suddenly says there's a higher chance of a thunderstorm, you're going to want your umbrella more.
Exactly. And that umbrella in the options world is your option contract. The higher the chance of a storm, the more valuable that umbrella becomes. On the other hand, for option sellers, higher implied volatility works against them.
Because the value of the options they sold increases?
Right. They're on the hook if those options become more valuable.
And I remember one video saying that vega is usually highest for at-the-money options, the ones where the strike price is closest to the current market price. Why is that?
It's because those options have the most extrinsic value, the most potential value that can be influenced by changes in volatility.
So if you expect volatility to rise, you buy options, you want a high positive vega. If you're selling and you expect volatility to fall, you also want positive vega so your position benefits from the decrease.
Right. Understanding vega is really important because a lot of the time, options traders are basically trading volatility just as much as they're trading the direction of the underlying price.
Okay, which brings us to volatility itself. Material differentiated between historical and implied volatility. Can you break down the difference and why this is important for option traders?
Sure, historical volatility, it's pretty straightforward. It's based on how much an asset's price has fluctuated in the past. You're looking at past data to get a sense of how volatile an asset has been.
So if a stock has a history of big price swings, it has high historical volatility.
Exactly. Implied volatility is a bit more nuanced. It reflects the market's expectation of how long the price is likely to swing in the future. And it's not directly calculated, it's derived from the current market price of the option. Higher option prices generally indicate higher implied volatility.
So implied volatility is more about market sentiment and expectations than past price movements. It reflects how uncertain the market is about where the price might go next.
Exactly. And comparing historical and implied volatility can be a valuable tool for option traders. If implied volatility is significantly higher than historical, it might suggest that options are overpriced, making it a good time to sell.
And if implied volatility is lower than historical volatility, that might mean options are relatively cheap, which could make it a good time to buy.
Right. And a classic example of this is what happens before events like earnings announcements.
Yeah, those are when implied volatility often spikes.
It's because the market is uncertain about what the company might announce and how the stock price will react. But then after the announcement, when that uncertainty is resolved, implied volatility often drops.
Right, and that's called the volatility crush, and it can have a huge impact on option prices, especially if you're holding options with high vega.
Exactly. That's why understanding the dynamics of implied volatility is so important for options traders. It's not just a number, it really reflects market psychology and expectations.
Okay, so we've covered a lot of ground here. We've talked about what options are, calls and puts, different trading strategies, and those key concepts of intrinsic and extrinsic value. And of course, we delved into the Greeks and the importance of volatility. But there's a final section in the material that focused on some important considerations and best practices for options trading.
Right. Let's touch on those because they are crucial.
The first one was liquidity. Why is it so important to trade liquid options?
Think of liquidity as how easily you can buy or sell an option contract without affecting the price too much. It's all about having enough buyers and sellers in the market.
So you're looking for options that have a lot of trading volume.
Exactly. That's a good indicator of liquidity. You also want to watch the bid-ask spread, which is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. A tight spread is better.
Right, that way you're not losing a big chunk of your potential profit just in transaction costs.
Right. It's about getting in and out of your position quickly and at a fair price.
So high volume, tight spread, those are the signs of a liquid option.
Yeah, and the material even gave some specific guidelines to look for.
Okay, next up, risk management.
Absolutely crucial. Before you enter any trade, whether it's options, stocks, anything, you need to have a clear understanding of your potential upside and your potential downside.
You need to know what you stand to gain, but also how much you could lose.
And this is especially critical with options because they can amplify both profits and losses. The material talked about selling naked options, where you haven't bought a corresponding option to limit your risk. That can expose you to potentially unlimited losses.
Okay, so naked options are basically a no-no for beginners.
They can be very risky. That's why strategies that use spreads, combining buying and selling options to define your risk, are generally a better approach for most people.
Right, it's all about managing that downside.
Always. Always know your maximum potential loss before you even enter a trade.
And don't forget about theta decay, that steady erosion of extrinsic value over time.
If you're buying options, you need to be aware of that countdown clock and make sure the price of the underlying asset moves enough in your favor and quickly enough to overcome that theta decay.
And we also need to be mindful of those changes in implied volatility, especially if we're holding options with significant vega.
Absolutely. Volatility swings can have a huge impact on option prices. If implied volatility drops, like it often does after an earnings announcement, the value of your options can take a hit, even if the underlying price moves in the direction you were expecting.
So it's important to pay attention to those volatility dynamics and factor them into your decision-making.
Absolutely.
The final thing the material touched on was options pricing models. Can you give us the layman's explanation of what those are and why they matter?
Sure. Options pricing models, they're these sophisticated mathematical formulas that are used to calculate the theoretical fair value of an option. They consider things like the underlying price, the strike price, time to expiration, interest rates, and of course, implied volatility.
It sounds complicated.
Yeah, the math behind them is complex, but the main takeaway is that these models help determine the prices you see when you're looking to buy or sell an option.
So the price you see isn't just some random number someone pulled out of thin air. It's actually based on these complex calculations that consider all these factors.
Exactly. And while you don't need to be a math whiz to trade options successfully, having a basic understanding of the factors that go into those calculations can give you an edge.
That's helpful to know. Okay, we've really covered a lot in this deep dive. We've gone from the absolute basics of what options are to understanding calls and puts, the difference between buying and selling options, all the way to exploring various trading strategies, the Greeks, and the importance of volatility.
It's been quite a journey.
Hopefully everyone listening now has a much better understanding of this fascinating and powerful world of options trading.
Absolutely. And remember, this is really just the starting point. There's always more to learn, and the key to success is continuous learning, careful risk management, and a deep understanding of what you're trading.
And speaking of continuing to learn, as you process all this information, what are the things that really stand out to you? What specific aspects of options trading are you most curious about now?
Maybe you're intrigued by some of those multi-leg strategies, the ones we didn't have time to dive into today. Or perhaps you're fascinated by the dynamics of volatility and how you can use it to your advantage.
Yeah, it's really a deep rabbit hole to go down. Maybe you're thinking about how the Greeks can help you make better trading decisions or how you can manage risk more effectively. There's always something new to explore.
Exactly. The journey into options is a continuous one, and it can be incredibly rewarding.
So keep those questions coming. Keep digging deeper, and most importantly, never stop learning. Thanks for joining us on this deep dive.